Listen-only mode.
So very good afternoon. Very good afternoon. Thanks for joining us. Today, I'm Dewoolkar. I'm product specialist with HDFC Securities. As you all know about, like market is very volatile. There are so many events in the market. So today we have a webinar wherein we are discussing most of the things wherein as an investor, so we have many questions like what all the events are there, what all the things would be there, how the market would be over the period of time, whether to invest now or should we wait. So we are here to answer most of the questions now. And today we have Ameya with us. So he's from HDFC AMC. Ameya is like CA and CFA, wherein the total experience which Ameya has like 10 years, and he is with HDFC AMC since 5 years. So, Amir, we have all the investors with us, and over to you so we can take it forward. And today's topic is market outlook, and there are some schemes which we'll be discussing. So, over to you, Amir.
Thanks, Dewoolkar. Good afternoon, everyone. Thanks for taking out time to attend this webinar. We'll be covering market outlook briefly, and then we'll cover two schemes of particular interest to you. So one happens to be HDFC MNC Fund, which is an ongoing NFO. Other happens to be HDFC Focus Ready Fund, a scheme I'm sure you would have heard about in recent times. It's one of the best performing equity schemes, not just in its own category, but across the equity fund landscape. So I'll just share my screen. We'll touch base on the market outlook first, and then we'll quickly jump to the fund section. So first and foremost, it's an interesting time to be talking about equity markets. In fact, the last 2 years have been quite a roller coaster ride of sorts for equity investors. In fact, for investors across asset classes, but more so for equity investors. Equity investors generally are used to volatility, but the kind of volatility that we have seen over the last couple of years has actually been a learning experience for all of us. In the investment industry. So first and foremost, some recent developments over the last 6 odd months. I'm sure you would have heard the R word, the recession word pretty often. So not in the Indian context, Indian economy is doing pretty well. We obviously are not looking at any kind of a recession or anything, but we are speaking when we speak of recession, it's more on the count of US or other Western economies or the global economy heading for a recession, or are we actually heading for a recession? That's the fundamental question. So one leading indicator of recession when it comes to the bond market happens to be the yield curve. Yield curve obviously plots yields at different maturities at any given point in time. So generally, you would see an yield curve which is upward sloping in nature. The lower end yields are at a lower level. The longer duration yields are obviously at a higher level. That's generally a upward sloping yield curve that you see generally in the market. Now, historically, it has been seen that in the months or in the year leading up to a recession, the yield curve inverts. So what happens is the yields at the higher end are lower than the yields at the shorter end of the curve, and that's what makes the term spread. Term spread is nothing but the gap between the yields at the higher end or the longer end minus the yields at the shorter end. That is something which is known as the term spread. Now that term spread, when the yield inverts, becomes negative, and that is exactly what happened in US since July of last year, July 2022, and that's something that you can see on the graph in front of you. So if you see to the right of the graph at the top, you can see that somewhere in the middle of last year it went below the zero mark. The term spread basically went below the zero mark, which shows that the yield curve inverted. So instead of becoming upward sloping, it ended up becoming downward sloping, which is generally a forebearer or generally a warning signal when it comes to recession. Historically, you can see in this particular graph itself, every time the yield curve has actually inverted or the term spread has gone below zero, that has been followed by a period of recession. So recession is marked by those vertical red lines in the graph on the screen. Every time the yield curve has inverted, every time the term spread has been negative, there has been a recession that has followed. But this time, even though the yield curve started showing signs of an impending recession, we still haven't seen a recession in the US. So what's exactly going on in the market? Um, Another indicator which again indicates that there could be some kind of contraction in the economy is the manufacturing PMI, which is the Manufacturing Purchasing Managers Index. The graph is on the screen right now. When that is above 50, it's generally an expanding economy. When it's below 50, it's generally said to be a contracting economy. And when it's actually well below 40, then I think that's actually a very dire state or a pretty bleak situation to be in. At this point in time, what we have seen is over the last 3 months, the PMI index in US has gone below 50. So right from November, when it was 49, then December it was 48.4. The latest reading Jan end it's 47.4. So what it shows is the index has been continuously printing or continuously showing numbers below 50, which shows a contracting US economy. So all of this would generally be followed by a recession. That's what an investor would think, right? But there are other factors at play as well. Uh, in the US, just like in some other economies, the consumer has a big part to play in the GDP. So there are different components to a GDP. Personal consumption happens to actually have a lion's share when it comes to the US GDP. The US GDP historically uh, is accounted for to an extent of 60 to 70% by personal consumption, by retail consumption, and those that segment of the economy is actually not showing any signs of recession. So in the last couple of months, in fact, over the last few weeks itself, we've seen that retail spending in US has picked up. Personal consumption expenditure has actually picked up, as you can see on the screen. From September till December, you had more of sluggish personal consumption, sluggish growth in disposable personal income. But when it comes to the month of January, both personal income, disposable personal income, and personal consumption expenditure actually ended up inching upwards. When it even if you adjust it for inflation. So what it shows is when it comes to consumption, and consumption actually plays a huge part in the US economy, as you can see from the graph at the top. The blue component is basically consumption's contribution to US GDP. 70% of US GDP comes from consumption, and consumption is not showing signs of recession at this point in time. And that's something, that's a particular indicator, that's a particular market feedback, which Federal Reserve, which is the RBI equivalent in the United States, and that they are actually going to be mindful of this when they are devising the future policy actions. And that's what leads us to uh, the higher for longer fixed income rates or higher for longer policy rates going forward, because there is absolutely no concrete indication that inflation has been quelled or has been defeated for good. There is absolutely no reason why the Federal Reserve would start pausing its rate hike cycle, or at least uh, show any indications of a reversal in stance. So that doesn't seem to be the case. Now, this graph may seem complicated at first for you, but what it shows is the Fed rate, the target Fed rate expected by the end of this calendar year. So Fed rate is nothing but the repo rate which you have in the Indian parlance. India, we call it the repo rate. In US, it's called the target Fed rate. The upper bound of that is mentioned in the slide here. Uh, at different points in time, the target for December 23 was different. So if you look at June 22, the majority probability was somewhere between 3 to 3.25%. So that was the expected Fed rate by the end of December 23 in June 22. So a year and a half. So basically, in June 22, the prediction for December 2023's Fed rate was around 3 to 3.25%. That's where 50% of the probability was found. As you move the window forward from June to September, September to December, December to Jan this year, there's a typo there. So that Jan 22 is actually Jan 23. And then you move the current time frame. What you can see is that target Fed rate has just kept on shifting to the right, or just kept on increasing. And now at this point in time, you're actually looking at close to a 70% probability of the Fed rate being somewhere between 5.25 to 5.5%. And at this point in time, we are at just 4.75%. So that still leaves you with upper bandwidth of around 50 or 75 bips of rate hikes even in the US by the end of this year. So absolutely no possibility of rate cuts this year in US, and that again is going to reflect in the monetary policies of central banks across the world. So that's something which needs to be watched out for. Interest rates are expected to be higher for a pretty long time, at least in the foreseeable future. So that for an equity investor, how does it matter? Generally, when the interest rates are higher, valuations tend to assume that much more significant. When the interest rates are lower, any expensive valuation can actually fly through. But during times where interest rates are pretty high, valuations actually assume center stage, and that's what has resulted in people speaking more and more of valuation, speaking more and more of valuation expensiveness in recent times. So with that being the background, we'll just have a quick look at the valuation landscape in the Indian equity market. The numbers are slightly dated. These are Jan end numbers. As you can see on the screen right now, we have just decomposed the Nifty 500 valuations into different buckets. The ones trading at 20% discount, the ones trading between 10 to 20% discount to the long-term average, so on and so forth. What we are seeing at this point in time is at the broader index level, if one looks at Nifty 100 or one looks at Nifty Mid Cap 100 or the BSE Small Cap 250 index, then the indices do look to be trading at a premium. So Nifty 100, which is the proxy for large caps, is trading at a premium of roughly 9 to 10%. Mid cap 100 is trading at a premium of 35%, and BSE small cap is trading at a relatively lower premium of close to 12% as of Jan end. Now, first look or first quick glance at these numbers would end up giving you this impression that, oh, the market is actually very, very expensive, then it doesn't make sense to invest. But that is actually pretty far from truth, because if you actually look at the constituent level numbers, what you can see is 50% of the large caps, close to 60% of the mid caps, and almost 70% of the small caps are still trading at a discount to the 10-year average forward P. And it's not like a 5-year average P that we have considered. We have considered a 10-year average P, which is price to earnings ratio. And that's a pretty long time frame to consider. Almost half, or in fact, more than half the index constituents, be it large cap, mid cap, small cap, continue to trade at valuations which are cheaper as compared to their long-term historical average. So that shows that there is still ample scope, still pockets of opportunity within the equity space that one can invest in, but you need to select the right kind of stocks, because the market at a holistic level is not extremely cheap. Another way of looking at valuations is from a relative standpoint as compared to the emerging markets. So, Indian equity markets historically have traded at a premium to the MSCI Emerging Markets Index. India is obviously an emerging market itself. So, it makes sense to have a look at our relative valuations compared to other emerging markets. And historically, we have traded at a premium, but that premium had shot up substantially over the last 5 6 months, and that premium was close to 100 odd percent a few months back. But after the recent correction, after the recent sell-off, we've seen that premium converge close to 50 odd percent, and that's pretty close to the long-term average of around 45%. So again, that shows that even at a broader level, relative valuations have uh, sobered down a bit over the last few months. Another interesting aspect happens to be on the rural economy. So post-COVID, obviously, the urban economy is one segment of the economy which actually recovered pretty well. But the rural economy kept struggling for various reasons, for multiple reasons. And that has actually started showing green shoots of sorts over the past few months. So the rural consumer sentiment index has started inching upwards, showing promising signs of revival. Agricultural credit growth, pretty good signs over the last couple of months. The Rabi sowing season has actually been pretty decent, much better than what we saw last year. Rural wage growth again showing an uptick. Tractor sales numbers pretty strong as well. Again, all these things viewed in conjunction show that brighter prospects could lay ahead for the rural economy. Although we need to watch out for what kind of weather patterns are seen over the next few months, because there are some indications that this will be a pretty warmer monsoon. The temperatures, the relative temperatures this year could probably be higher on account of the El Nino effect, which generally is accompanied by relatively lower rainfall and relatively higher temperatures. That is again a headwind of sorts to the rural economy. But as things stand, pretty bright prospects on the rural front. So with this, we'll briefly touch base on The two funds in question, which is the HDFC MNC fund and the HDFC Focus 30 fund. Devakar, is the screen visible for HDFC MNC fund? I've shared, just switched the presentation. Just confirm if it's changed on the screen.
No, it is not changed yet. So we can see the rural consumer sentiment screen only. Ameya, are you there? Uh, uh, So all the attendees, sorry for the inconvenience. There is some technical issue with Ameya's and just hold on for a minute. Let me address that and give us some time. Sorry for the inconvenience.
Devakar, I think I'm audible right now. Devakar, I finally hope I am audible now.
Yeah, man, you are audible.
Yeah.
You can go ahead.
Okay. Yeah. Apologies for the technical glitch. We'll just take it from where we left some time back. So, sticking to the MNC fund, which is one of the funds in focus today. We obviously spoke of the market outlook. I hope I gave a broad overview of where we lie in terms of valuation, where we lie in terms of the equity market outlook, the macro fundamentals that we are looking at. Now, moving on to the funds section, two funds in focus today. One is the HDFC MNC fund, other is the HDFC Focus 30 fund. Uh, MNC fund is obviously the NFO that is going on right now. You would have heard about this. You would have seen emails on this front. NFO period gets over in few days from now, which is the 3rd of March. It is a pretty good opportunity for investors looking to diversify their portfolio beyond the usual uh, names that one ends up seeing in a generally diversified portfolio. But before going on to the nuances of the product, I'll just show one particular slide on the screen. I hope it's visible. There are roughly 28 odd brand logos on the screen right now. Uh, Obviously, we can't take a poll because this is a virtual session. But if we actually ended up taking a poll, I'm sure at least 95% of the participants would be able to recall or relate with at least 25 out of these 28 logos that you see on the screen in front of you. So you have day-to-day brands like Pepsodent, Colgate, Dow, Maggie, and you have brands like Baleno, Brezza, Swift, so on and so forth. So you actually have the entire gamut of activities uh, or entire range of day-to-day products that any person uses being covered in this particular slide or in terms of these in the form of these logos on the screen. All of these happen to be MNC brands. For your information, I am sure most of you would have already figured that out. These are basically MNC brands, and the fact that any person, right, from the northernmost section of the country to the southernmost tip of India would be able to relate with these brands just bears testimony to the fact that MNCs by themselves create a pretty strong brand presence in our everyday lives, and that's simply not a coincidence. There is a reason attributable to that as well. So most of these MNC companies actually spend a fortune on the R&D expenditure. They spend a lot on technological innovation. They leverage the R&D expenditure or R&D potential of their parent companies. So Hindustan Unilever, for instance, leverages the potential of Unilever PLC, which is the parent company, to keep on coming up with new products every single month, year after year, and that itself gives it an edge as compared to some of the Indian counterparts. Apart from that, they also spend a huge sum on advertisement expenditure. That again is reflecting in the kind of numbers they show in terms of advertisement expenditure as compared to the net sales. So ad expenditure as a percentage of net sales is almost three times as much for Nifty MNC companies as compared to an average Nifty 500 company. So they spend a lot on R&D, they spend a lot on advertisement, and that reflects in the kind of brand creation that these MNCs have. MNCs also historically have shown better top line growth as compared to Nifty 500 companies. They have better PAT growth, better PAT margin as compared to Nifty 500 companies. They're not just focused on profitability, but they also have a prudent balance sheet. So there have been instances when we have seen that there are certain companies which focus a lot on profitability, but they actually don't focus a lot on their asset, the nature of the kind of debt they have on their balance sheet. So during good times, it works for companies, but during bad times, having extremely over leveraged balance sheets is a pretty detrimental thing. And with MNCs, that's something we need not worry about, because MNCs generally have asset light balance sheets. They have lower debt on their balance sheets. And that's one of the reasons these kind of companies actually are much more resilient during bad times. Speaking of resilience, there is one particular slide that may be of interest to you. So when you look at the track record of MNCs during bad times, during volatility, it is there for you to see. Nifty MNC index, if you just check the four key events of the last 2 decades: tech bubble, global financial crisis, COVID, geopolitical uncertainty. In each of these four key events, you can see that Nifty MNC index has actually outperformed the Nifty 500 comfortably, or at least reasonably. So during tech bubble, there was an outperformance of Nifty MNC index of close to 31%. During global financial crisis, that outperformance was 11%. During COVID, 7% outperformance. During geopolitical uncertainty, which is in the aftermath of Russia's invasion of Ukraine, even in that time frame, MNC index outperformed Nifty 500. So what it shows is, because of their strong brand identity, because of their strong focus on innovation, because of their asset-light balance sheets where they have lower leverage, lower debt, these kind of companies actually are much more resilient during bouts of volatility. And that's exactly um, uh, the kind of companies that you would want to have in your portfolio to an extent, especially when things are obviously in a state of flux, when you're expecting some kind of volatility as we are at this point in time. So in that with that background, obviously you would want to have these kind of companies, this kind of a portfolio as part of your diversified equity portfolio. Now, coming to the returns part of it, over longer time frames, in fact, Nifty MNC index has outperformed Nifty 500 pretty comfortably over longer time frames. So over 5 year periods on a daily rolling basis, Nifty MNC index has outperformed Nifty 500 in almost 80% instances. So we basically considered 5 year periods on a daily basis for the last 10 years, and compared the returns of MNC index versus Nifty 500. In 78% instances, Nifty MNC index outperformed Nifty 500. So that's the long-term track record of Nifty MNC index, and obviously, in turn, the universe of this fund right there in front of you in terms of performance. So that's the kind of resilience, that's the kind of performance track record that you can expect from MNCs over a longer time frame. In terms of the portfolio, so this is a thematic fund, as is the case with any thematic fund. This fund will have to invest at least 80% of its net assets in the underlying theme. In this case, the underlying theme happens to be MNCs. Now, what exactly will come under MNCs for the HDFC MNC fund? So, any company having foreign promoter shareholding greater than 50%, or any company which is part of the Nifty MNC index, will be part of the underlying universe for HDFC MNC fund. We'll have a maximum of 30 stocks. So we'll basically run a focused strategy of high conviction stocks in this particular fund. 80% net assets in MNCs, at least 80% net assets in MNCs. We'll have a benchmark agnostic approach. So you would have seen that the benchmark has some kind of a skew to consumption, some kind of a skew to consumption, consumer discretionary, consumer staples. But when we are running this fund, we won't be mindful of the benchmark weights. We'll have a pretty differentiated approach. So, say for instance, healthcare, for instance, is 12% in the benchmark. And that doesn't mean that HDFC MNC fund will have close to 12% in healthcare. We can have as low as 2%. We can have as high as 20% if the universe permits, if the liquidity situation merits their inclusion to that extent. So, with that being the broad structure, uh, we'll run the portfolio in HDFC MNC fund. Also, the residual 20% of the portfolio could be invested in companies having some kind of an MNC theme. So, any Indian company having at least part of its turnover or revenue from outside India. So, now, for instance, an IT company, for instance, has 70-80% revenue from overseas. Now, under the promoter shareholding criteria, that doesn't qualify as an MNC. but for all practical purposes, it can be construed as an Indian MNC. So, say for instance, an Infosys or a TCS, the bulk of their revenue coming from other geographies, they could be deemed, they could be considered as Indian MNCs for all practical purposes, and we'll include those kind of names in the residual 20% of the portfolio. The names that I've mentioned are purely for the sake of illustration. It doesn't really convey any kind of intention to buy those names specifically when the portfolio is constructed in the few weeks from now. In terms of the investable universe, the index is largely a large and mid cap index with 29 out of 30 stocks being large and mid cap companies. When you look beyond the index and you look at Nifty 500, you're left with around 54 odd MNC eligible companies in Nifty 500. 10 companies are large caps, 27 are mid caps, and 17 companies are small caps. If you look beyond Nifty 500, then you're left with another 88 small cap companies. So put together, you have roughly 142 odd MNC eligible companies across large, mid, and small caps. And finally, the most important aspect when it comes to an investment in a thematic fund. So any investor who wants to invest in a thematic fund obviously looks at it from a diversification standpoint. Uh, Even if you ignore the other aspects like quality or brand creation or wealth creation of MNCs and just focus on diversification, even in that case, there is a reasonable merit for inclusion of HDFC MNC fund in the portfolio. Uh, Generally, you would have seen any diversified equity portfolio, any investor, even with investment across multiple funds, would generally have 60 to 70% overlap with Nifty 500 in terms of the portfolio. But when it comes to the MNC index, it has an overlap of barely 6 to 7% with Nifty 500 or Nifty 50. Consequently, the funds overlap with Nifty 500, HDFC MNC funds overlap with Nifty 500 or Nifty 50 would also be consequently lower. So any exposure to HDFC MNC fund by itself provides good diversification benefit to investors. So even from that standpoint, investors can consider investing in HDFC MNC fund, but with an investment horizon of at least 3 years, because in the short run there could be instances where MNCs may underperform. There could be time correction at times in certain segments of the economy, but over a longer time frame, if you have an investment horizon of at least 3 years, some allocation, some component of your portfolio can go to the MNC fund, and we would suggest an investment horizon of at least 3 years, but preferably 5 years if you're looking at investment in HDFC MNC fund. Another fund that I was going to touch base on briefly, but I think due to paucity of time, I'll just briefly on that without sharing the screen, because again there could be some issue with screen sharing. The other fund which I was referring to is HDFC Focus 30 fund. Another fund that's another fund where the maximum number of stocks is 30. But unlike the MNC fund, it has a diversified mandate. So you don't necessarily need to invest in MNCs. It can invest in MNCs, PSUs, all kind of companies across market cap segments, across sectors. So that's a pretty wider canvas to play with as compared to a thematic offering. HDFC Focus 30 fund can be a core component of your portfolio. MNC fund, on the other hand, can be a tactical or diversification play for your portfolio. Focus 30 fund, HDFC Focus 30 fund, as I said earlier, is in fact the best performing fund across equity categories, not just in the focus category, but across all equity categories. It's one of the best performing fund over the last year and a half. Our overweight to defense, our overweight to corporate banks, and our underweight to IT actually played out pretty well for us over the last 15 odd months, and the returns are there for you to see on a relative basis on an absolute basis. So that's another fund that you can consider. SDC Focus 30 fund. I'm pretty sure you would have heard about that fund over the last year or so. So with this, Devakar, I think I'll hand it over to you. We can take any questions on any of these funds or other offerings from HDFC Mutual Fund.
Yeah, thanks, Ameya. Thanks for sharing the information, which is very insightful. And I request all the attendees, if you have any question, you can write it in the question box so we can take it forward. Ameya, we have one question from Mr. Narayan Rao. Like the fund, the MNC fund, which you were talking about. So, is this high risk fund Uh, so that's the question
So
from
general,
the.
so it's a pretty diversified fund. Yes, it's a thematic fund, but unlike a regular thematic fund which focuses only on a particular sector or a narrow theme, MNC theme itself is pretty wide in nature. So you have exposure to seven or seven, eight, nine sectors in this particular theme. You have exposure across large, mid, small cap segments. So by itself, the diversified nature of MNC is also the fact that MNCs generally are more resilient, have relatively lower volatility as compared to the broader market. That itself means that MNC fund, although it's thematic, is not as risky as other thematic offerings.
Okay. And another question is like how focused fund is better than flexi cap fund. So focused fund is better or flexi cap is better. So what do you suggest?
So both flexi and focused have a diversified mandate. There is no restriction in terms of market cap allocation. There is no restriction in terms of sectoral allocation. So both have their own pros and cons. When it comes to flexi cap, obviously the number of stocks there is no limitation. So in that sense, it can be pretty much diversified. You can have 50 odd stocks in that portfolio. You can have 60 odd stocks in that portfolio. It's pretty diversified on that front. That's a pro for a flexi cap fund. On the contrary, what works for a focus 30 fund is the fact that because it's a narrow portfolio of 30 stocks, you only have the best or the most convincing names of from the fund house's point of view in that portfolio. So you'll have only the best of the best from our point of view in that focus 30 fund. Probably there could be a same stock in HDFC Flexi Cap Fund and Focus 30 Fund, but in Flexi Cap its weightage could be 4 odd percent, and Focus 30 its weightage could be 8, 9, 10%. And if that works out pretty well in terms of alpha generation, and that's something you would have seen over the last 15, 18 months, where the kind of alpha that Focus 30 Fund generated was actually like phenomenal. So there was an outperformance of 8, 9% even over the category median. We are not even referring to the benchmark. Category median itself was outperformed by this fund by 8, 9, 10% at times. So that high conviction of Focus 30 is a pro in its favor. So depending on what's your risk appetite, you can choose between Flexi and Focus. Focus happens to be uh, relatively riskier as compared to Flexi Cap, as you would be aware.
Okay. So, like we have MNC fund now as an NFO. So, in this market, we are hearing that US market, the recession would be there, or there are many things which we are listening now. So, is this a good time to participate in MNC fund?
So as I said earlier, we are not trying to time the entry in terms of the market when it comes to SDC MNC fund. What we are looking at is this is an all-weather product. This is a product which provides good diversification benefit. This is a product which provides good resilience during market volatility. And even in terms of valuations, for instance, there is still pretty good pocket of opportunity even within the MNC space where one can be selective and pick the right stocks from a long-term perspective. So it's not like a another other thematic product or other sectoral products where you actually try to time your entry into the product. This is an all-weather product. You can actually look at it from a long-term perspective, from a diversification standpoint, rather than from a timing perspective.
Okay, if so we have one more question. So, like in present scenario, should SIP be done or lump sum amount be invested in HDFC focused fund and time horizon for such funds?
So generally, we obviously recommend SIP for the simple reason that you end up averaging your cost over a longer time frame. Uh, an average investment horizon of 5 odd years is something which works in your favor. Also, with markets being volatile, SIP is the way to go because you've seen historically that an SIP doesn't really matter whether you start an SIP at the peak or at the bottom over a longer time frame on a 10-year, 15-year basis. You end up getting pretty good returns or good returns irrespective of when you started that SIP. So in that sense, SIP is always the way to go. From time to time, when there is market correction, you can obviously top it up with some lump sum investment.
So if anyone has any other question, you can write it in the question box, or we can address that. So like we have we have limited time now. If anybody wanted to ask anything. So Ameya, I think we are good here. So we don't have any question as such. So thanks for sharing all the details, and I would like to thank all the attendees who has joined us now. And I would request you all to get in touch with your RNs. So whatever queries you have, because in this volatile market there are many options which are there in the market, which they will definitely guide you. They'll tell you what all the options are there, which are good, which we can add in the portfolio. So get in touch with your RMs, and if there'll be anything, you can get in touch with us. And thanks for joining once again. Thanks, Amay. Thanks for joining.
Thanks, Dewoolkar. Thank you for giving us the opportunity to present on this one.
Yeah, thank you. Bye.